recovery that has largely been driven by their purchases.
Yeah. Well, let's look at the wage growth. Are we going to get the wage growth, Paul? Because we've seen Walmart come out yesterday with a one-off bonus and a nice little lift to anyone coming in the entry level. $11 an hour will be your minimum wage. We've seen others follow suit as well. Are we going to see that tax bill implementation, whether it's the tax bill or not, is that going to start happening in a bigger way?
You know, there's been all sorts of signs, anecdotal evidence, the NFIB talking about tough to find skilled labor, you know, that's going to cause increases in wage pressures, but it's just not coming. You know, you have this issue of worker mobility, so moving to jobs, it's a lot tougher for workers to do that right now. So we've been looking for signs that wages are going to go higher, but it hasn't come yet. And so I think, you know, it's one of those things, we keep waiting for it, but it doesn't happen.
Something that is happening is high yields, whether the wages come through or not. We're getting higher treasury yields across the curve, 2s through to 10s, through to 30s. Stuart, when does it become an issue for the equity market?
I mean, if you actually look at the report today and you see the 8:30 release, equities tick down a few basis points, obviously not a massive move, but you know, the real issue here is emerging markets as opposed to developed markets. And within developed markets, I think the key issue is the tech sector. So if you think about how the tech sector has outperformed since the beginning of QE, you have roughly a NASDAQ over S&P outperformance of over 200%. Now, why does tech outperform? Well, you know, generally, some of these technologies, et cetera, don't necessarily produce revenue in year 1 or year 2, or produce earnings for that matter in year 1 or year 2. So that future income is discounted at a lower rate. So on that basis, we have an expectation that, you know, even if Treasury yields go to 2.75 or 3%, you're going to have significantly higher NASDAQ volatility relative to the S&P.
That's an interesting point. On the broader point, the amount of nervousness that I've seen this week around central banks, full stop. First there was the BOJ, then there was this concern around what China was going to do with their treasury holdings, and then we had the ECB as well. They're marginal shifts. They're not big issues. They're very small things for the Bank of Japan and for the ECB as well. But the outsized moves off the back of them are really notable, Lisa.
They are notable, and the number of stories afterwards explaining it as not just the subtle shifts in policy talk from these central banks has also been notable. People are basically saying, look, this has been a week of very big issuance from a number of European countries like Italy. They've been selling a lot of longer-dated bonds. This could have created a little bit of a distortion, and meanwhile, things are kind of normalizing. I mean, forget some kind of massive sell-off. Things are sort of normalizing as people understand that this year is going to be different in the stage of recovery.
And Paul, the recovery is getting real as well. The start of last year, we talked a lot about soft data surprising to the upside, hard data not responding.
Looks like they took away the ABC News and put Bloomberg TV instead.
And all of the economic data in the United States is like right up here. Are we seeing peak growth? Can expectations get any higher, and can the data deliver?
Well, that's the worry. You know, when things are as good as it gets, I mean, can they get much better? But I mean, I think getting back to when we're looking at it, we have auto sales near their highs, we have housing starts near the highs of the cycle, but still plenty of room for growth. And when you look at ratios leading to coincident indicators, that ratio is right near the highs of the cycle. So there's no signs yet that this economy is, you know, peaking out or starting to roll over. So, I mean, you got to just stick with it until you start to see those signs. One thing, jobless claims up 4 weeks in a row, but it's 260,000. Been under 300,000 for 3 years. So, I mean, 300,000 used to be the holy grail.
We're near multi-decade lows. Quick final point, Lisa.
Walmart announced wage increases. They also quietly later announced they're going to be laying off about 1,000 or more than 1,000 people as they shuttered some Sam's Clubs. So this is a tension. It's not quite clear.
A valid point. Bloomberg's Lisa Abramovich. We've got to let you go. To Michael McKee, a special thanks to you as well. Stuart Walder at BNP Paribas and Paul Hickey of Bespoke will be sticking with us. Coming up on the programme, Facebook, prioritising friends and family apparently, but the move costing a stock a buy rating. The man behind the big Facebook downgrade joins us next. The stock in the pre-market off by 5.5% from New York. This is Bloomberg.
So we see this hard fall Facebook has done in the pre-market so far. So give it about a couple days, like 2-3 days. Probably by Tuesday and Wednesday, will probably become a good buy, and you'll see it climb right back up. If you look, it does that a lot. It takes a big hit, takes a big hit, takes a big hit. Wait a couple days, and climbs right back up. And then it goes up even higher. Granted, today was the bigger hit than those 3 other times right there, but just wait. Probably about Tuesday and Wednesday, you buy it, and it goes right back up.
From New York, counting you down to the market open, I'm Jonathan Ferro. This is Bloomberg. It's time now for our morning calls. A look at some of the big movers on the back of analyst recommendations. First up, JP Morgan downgraded Amex to neutral from overweight based on valuation. Amex has rallied some 31% over the past 12 months. Next up, BTIG raising its price target on Twitter to $30 a share, matching the highest estimate on the street. The analyst saying Twitter is in the early stages of a multi-year turnaround. And finally, shares of Facebook taking a hit this morning after the CEO Mark Zuckerberg said the company was making major changes that will mean people spend less time on the site. The analyst at Stifel is concerned, saying there is too much uncertainty relating to the economic impact of Facebook's pending newsfeed changes for us to be comfortable retaining a buy rating on the stock. Joining us now on the phone, one of the analysts behind that call, Scott Devitt, Stifel Internet Equity Research Managing Director.
Yeah.
So Scott, walk us through. Is it a little bit premature to do this before you hear the earnings call later this quarter? But what is concerning you the most?
Good morning, Jonathan, and thanks for having us on. You know, it was definitely a difficult call.
5 minutes 20 seconds till the market opens.
I think the dilemma is, you know, as follows. Facebook, in many ways, I think, lost its way, and you began as a service to focus less on users and more on monetization, which there's a delicate balance with that in any advertising-supported model. And now you're seeing, you know, the company very specifically begin to go back towards its roots, which has negative consequence from a monetization standpoint. You don't know how far. You really can't quantify the impact. But in the near term, it's pretty clear that that impact is financially negative. And it makes it very difficult to suggest that investors buy the stock on the dip versus just waiting for more information to ultimately see first the economic consequence, and then second, the long-term benefits to the platform, which should be the end result, which is a positive, and we do commend the company for finally taking this step.
So, Scott, in many ways, we've been told before, suggested that ad revenue would slow. It didn't. We're now being told engagement might drop off. Will it? Why is it different this time around? Why is the guidance from the company actually going to become reality?
Well, part of it, you know, may be that this guidance is coming from the founder and CEO directly on multiple occasions after, you know, some pretty public attacks that the company's faced, whether that's from Washington, D.C., from Europe, or from Silicon Valley itself. And so this is more real than I think a company giving conservative guidance, and it's something that investors should pay attention to. It too may pass, but it's a significant event.
Paul Hickey?
So, Scott, I mean, going through the company's prior engagement levels, do you think this is, I mean, like you touched on a little bit before, but do you think this is a necessary trend that they have to do? Because, I mean, from our work and what we've done with the company, we've seen that engagement is already starting to decline, and people are just becoming frustrated because the usefulness of the utility of Facebook has been on the decline.
It's a great point, and you know, and I think it is. There has been some supporting evidence of that in Facebook's own disclosures of engagement, which is daily active users over monthly active users. You begin to see modest degradation in the past few quarters, and then third parties as well. You've begun to see it, and it's hard to know whether that will stabilize, improve. It does seem, though, that it's going to get worse before it gets better, specifically as it relates to time spent, because that's where the focus of this shift is. And so when you have a company that's really valued on and is able to generate revenue and profits off of that engagement, and this founder and CEO is telling you that that's likely to go down, you know, it goes from being a yellow flag to a red flag pretty quickly.
Scott Devitt, great to get your insight. Really appreciate it. You giving us your time here on Bloomberg Television. Thank you very much. Joining us from Stifel, the stock down by just over.
So, just real quickly, guys, a little heads up for next week, what the plan is. So next week, to be able to watch the stream, you do have to be a subscriber on our website at knkstrategies.com. The next thing I also wanted to mention is on Monday is actually a holiday, so Martin Luther King Day. So Monday the stock market is actually closed. So we will be streaming live again on Tuesday for the stock market. So that being said, like if you're interested about the Facebook buy that was just on the news and it took that huge dip today, I recommend waiting for at least Wednesday and seeing a little bit, what is it doing, what the report is. Because by Wednesday we should have a little bit better of an idea, and then we should be able to see it climb back up in that near future. Let's see here. We got a couple more minutes, just a minute and a half until the market opens. Currently, what I'm invested in is for that dividend trade that I was doing. Currently in ARR. So I'm hoping that goes back up soon because it's at 25.20. I need to sell it anytime above 25.35 to walk away with money. So that is the goal there. Best case scenario, well, second best case scenario is 25.53 that we sell it at. But 25.35 and higher is where we want to sell it at. Remember, if you have any questions, concerns, or if confusion about anything, make sure you're asking in the chat. I'll be more than happy to go over anything that you guys are looking at. We've got about 25 seconds till the market opens. Buyers are trying to get in as low as they can in the pre-market right now on it. 3 seconds. Here we go. Let's try and climb up already. Oh. Remember, this is a low volume stock, so the movement may be just a little bit slower for us, but that's okay.
Counting it down to the market open, JP Morgan kicking off earnings on Wall Street. The market choosing to look past any tax-related pain in the previous quarter and looking forward to some tax-related gains in 2018.
Sellers raised it back up.
Firmer by a couple of points, by not even a tenth of 1%. We'll get our teeth into those earnings in just a moment. Nasdaq futures are...
Alright, so the bell is just ringing now while it's been open already for a minute. So that's something that they should work on their new program. Let's see here.
As core inflation accelerates, but the dollar still can't get a bid. It's a Euro strength story. 91.27 is how the dollar index trades, down by 0.6%. With me around a table to
I have a lot of sellers waiting at the 31 right there.
Paul Hickey of Bespoke. So more all-time highs after all-time highs, and vol just not picking up, Stuart. Is that going to change anytime soon?
No, we really don't think so, and I think part of that is because if you look at the economic data, the
Histogram says it's going to try to go down.
not moving around relative to expectations. So, but, you know, if you look at the
Which
data
we may
today,
see. It's
core
okay.
inflation rising, if that were to persist, that might you know, signal a rise in vol, but you know, everything else is sanguine, and on that basis, we actually expect realized vol to be around 5 or 6, given the level of
Okay,
economic data that we
there's
have
a
right
buyer
now.
at the 30, so that's good.
Aside from maybe an exogenous shock, it's really hard to call any move higher in vol.
Paul, you see the same thing?
You know, so I think we're into earnings season now, and the key with earnings season is expectations. And
Buyer at
expectations
34,
have never been
28
this high
right
in
now.
earnings season in the last decade. So when you have the bar set high, it creates the opportunity for disappointment. Conversely, the last 13 quarters, we've seen more negative revisions than positive revisions heading into earnings season. S&P was higher in those earnings seasons 12 out of 13 times. In the last 10 years, when there's been more positive revisions, 7 quarters, S&P's been down during earnings season 4 times, up 3 times. This is more positive than the pace of upward revisions than we've seen in the last decade. So you have to watch the reaction. Already since the start of December, 25 companies have reported in the S&P. A quarter of them, from when the opening bell to the closing bell, they sold off from the opening to the close on the reaction. So we want to see how the banks perform. I think, again, JP Morgan, if they can finish flat today, that's a positive sign.
So you're considering a meet a beat this quarter?
I'm considering, it doesn't matter, it's expectations. So everyone's expecting strong earnings. So that's a given. Now, are they going to exceed to the pace that...
Let's see if we can undercut by 1.
...is already based in and priced in.
Well, Stuart, do you see that? Because some people out there are actually saying to me it's the strategists that are bullish. The strategists are bullish because they've accounted for the tax bill. The analysts are waiting to see what these guys say on the call so they can adjust their numbers for this year. Do you see that distinction, Stuart?
So generally, of course, the strategists tend to be less bullish than the bottom-up analysts. But in this case, I think we have a bit of the opposite. And you know, when it comes to earnings, and this goes back to the prior point, we've seen actually in the last quarter a significant amount of earnings-related volatility, especially around the consumer staples and the consumer discretionary sectors. And because of that, if we look at the implied earnings moves, the options implied earnings moves around the event dates this quarter,
so these two that are trying to sell at 37 is actually me, and on my other accounts as well.
Extremely high relative to history. So on that basis, we would expect them to essentially wash each other out, low correlation, and thus maybe S&P doesn't move, but we get a lot of interesting single stock stories.
So if you had a conviction trade and there was a big opportunity out there at the moment, what is it?
I think one of the key things that we've highlighted over and over again is the potential outperformance of Europe over the S&P. And in this case, I really think, you know, on you know, kind of combining the banks factor with the larger regional call, you could see Euro stocks, banks actually outperforming the financial sector in the U.S.
Did you see the same thing, Paul?
Someone just undercut at me at that 36.
I haven't seen it on the screen in the way people thought this would bear fruit. Are you going to see it this year?
As far as outperformance of international...
Europe versus the United States, banks specifically.
I mean, the markets overall, these outperformance cycles tend to go in years. And the U.S., the outperformance we saw in European markets on a dollar-adjusted basis started last year. I think that can continue because of the weak dollar here. And then on the separate side, energy, weak dollar is going to benefit there. You have oil over 60, biggest beneficiaries of the tax break. And, you know, so those aspects as a whole should do well for the sector.
Why can't the dollar get a bid?
I mean, you're seeing global growth, so all that money that
Kind of want to keep it at the 37 where I'm trying to sell it at.
flowing back out.
Paul Hickey, it's great to have you with us. In the markets today, we're about 4 minutes into the session. The story as follows. Gains across the board, up by 0.4 on the Dow, call it 95 points higher. Another all-time high there, and the S&P 500 as well. Positive 0.1%. Let's get you some movers, shall we, and cross over to Abigail Doolittle.
Well, check out Facebook, John, down more than 5%, on pace for its worst day since November of 2016. This after the company announced big changes to prioritize friends and family over brands and businesses. And CEO Mark Zuckerberg is saying this could cause people to spend less time on the site, but the time they do spend on Facebook will be more valuable.
Don't see any penny stocks again today. I don't know why this month has been not the best for penny stock movements. But
has raised its price target to $30 per share, and is also saying that Twitter could be an acquisition target. Also Also lower, Advanced Micro Devices down 1.3%. This after the company is backtracking around the Intel chip flaws, saying 2 of the 3 weaknesses could put its own microprocessors at risk. Investors clearly not liking that update. And then finally taking a look at the big banks, JP Morgan hitting an all-time high after reporting its 4th quarter. Trading revenue, of course, was well below expectations.
Maybe I'll change it to 36 instead.
Had been for a decline of 19%, but the focus, of course, on the positive effect of tax reform next year. Wells Fargo down well off the pre-market lows, though. They missed top and bottom line estimates. Net margin missed as well, another legal charge. So Wells Fargo down just a little bit. Tale of two cities, though, there perhaps for the big banks, John.
Abigail, thank you. Joining us on the phone now, I'm pleased to say, is Gerard Cassidy, RBC Capital Markets US Bank Equity.
All right, so NYSE and XNets. Okay.
Yes, we like what the future is going to bring for these banks.
NYSE.
Fourth quarter numbers were generally in line with expectations, as you just pointed out on your show here. Wells came in under, but both JP Morgan and PNC were the other 2 big banks that reported, and they were ahead of expectations. But it's really about what's going to happen in 2019 due to the tax reform and the impact on the economy.
Gerard, I'm just looking at some of your calls for next year, for the year 2018. Outperform on JP Morgan, price target 110.
Looks like it may take a little dip though. ARR is struggling as well, where I am in. I have it set to sell at 36, but I couldn't do it.
Because of the impact of tax reform. But you're right, the bank stocks have moved through price targets throughout
XNet.
due to the strength in their earnings, partly coming now.
That is a huge
Looking at the story across the whole
down
going into next
for that
week,
penny
just
stock.
read across
Gap
what
down.
you've learned from, say, JP Morgan and Wells Fargo, and how you can push that forward to, say, the Cities, the Goldman Sachs, the Morgan Stanley.
Looks like it may trying to curve though to go back up a little bit on the 1 minute chart.
Trading continues to be weak. We saw that in the JP Morgan numbers. Even when you take out the one-time charge, the market's revenues were about down 16 to 20%. Second, we would also point out that the commercial lending businesses are doing well, and we should see that at the other banks in addition to what we saw today. So capital markets businesses in trading continue to be weak, but traditional commercial banking businesses are stronger, and we should see that show up in the other banks as well.
Well, Gerard, let's talk about traditional banking, just borrowing, lending, the kind of things that banks do. They pay interest on deposits, then they lend money out, and hopefully they get a bigger interest rate. Net interest margins have been growing off the back of Federal Reserve interest rate hikes, and that's mainly because deposit beta has been so low that they haven't passed on those interest rates to the deposit base. Is that going to change anytime soon?
I would say not in the immediate future, but we
ARR started right back up here.
Customers will see the higher interest
Good.
rates. We think later
1 minute on the XNet. Looks actually pretty good. Looks like it's really trying to climb back up. So you may actually see that climb up and have that break up from right here.
2019 on the back of the Fed fund rate increases that we expect this year and next year.
So, Gerard, if that is the case, if that materialises through this year and through next year as well, what do you expect? What do you forecast? What's the base case for how the net interest margin evolves? As some
So
of these
close to
big
making
numbers?
the X right now. We would have to wait till the next one starts. The stochastic is really close to each other as well, so and it's trying to bounce down. It's just like moving very slowly on the stochastic, so it's very important to keep an eye on that.
Gerard, I do want to wrap things up by talking about what's happening with the credit card business over at, say, JP Morgan. What do you see in the numbers today?
We saw very strong volumes in the numbers in the fourth quarter. It suggested, as we've already known, that the Christmas selling season was strong. We saw receivable growth that was very strong, and actual volume usage was quite strong as well.
We've seen a lot of growth in this space over the last several years, even before we get this tax boost to growth this year. Are we reaching any kind of inflection point here, Gerard? Some kind of saturation?
Looks like you made the X on the stochastic, so be very careful right now if you go in, because it may do a little bounce down and may not form the X all the way.
So I think that actually the inflection point has been pushed out because people are going to have more income, both from lower taxes and higher wages.
Gerard, stick with me. I want to bring in Paul Hickey of Bespoke. Paul, the situation on Wall Street right now, there's a business model you really want exposure to. off the back of this economy, you really want to leverage, say, a pickup in the US economy. What kind of business model is it, and which bank fits the bill?
I mean, as far as, that's not my specialty. I don't focus specifically on the financial sector. So, I mean, I think that would be, going back to Gerard, I think where do you think the margin expansion or the valuation expansion can take place within these banks, and as far as the regulation wave is concerned, and where are we in that phase right now?
I think the valuation expansion comes from higher return on equity for the banks. Over the last 5 to 7 years, the return on equities for the banks has been depressed. This lower tax rate is certainly going to help it, but more importantly, and you touched on it,
NYSZ, it looks like it may actually try to climb back up right now, so.
Back that excess capital. So the valuation increase for the banks comes from higher profits coming from the tax reform and then lower amounts of capital. And those ROEs, which we thought were going to be in the 10 to 11% range, now I think can get to 12 to 13% for the industry. Still down from the 15 plus prior to the crisis, but higher than what we originally thought.
Gerard, sentiment has changed around deregulation and regulation full stop quite drastically. Are we actually going to see some concrete steps this year, some real changes?
Yes, I think so. In fact, right before Christmas, we had a concrete, definitive example where they changed the Shared National Credit Exam metrics, where it used to be any loan over 20 million with 3 lenders on it. Went through a special exam. They boosted that.
NYSE looks pretty good.
Believe it or not, 42% fewer banks now will be going through the Shared
It's
National
struggling to
Credit
go down
Exam.
with the MACD. Histogram is still staying around the same too, so. ARR is really trying to climb back up right now. A little bit more buyers at the 26. There we go. We should be able to be fine and keep that 36 where we have a sell order at on both accounts.
Record highs across the board, up by 100 points and some on the Dow, up by 0.2% on the S&P 500. Record after record, we keep printing more of them. In the bond market, here's the story for you. 10-year note yields punch higher by 3 basis points. The 2-year punches through 2% for the first time since 2008, but the dollar still can't get a bid. The dollar index lower by 0.6%. A weaker dollar story in G10, with euro dollar through a 121 at a 3-year high. From New York, this is Bloomberg.
Stochastic on the NYSE though, it is starting to go above the 80, so just be careful there, but histogram and MACD are kind of staying by each other, so they're not really moving too much. XNet may make the X in the next 1 minute candlestick, because it is touching here and it is trying to bounce up from the 20 on the stochastic, so that may be really good. Looks like it's trying to form the X here. It's climbing over it a little bit. XNet. Here's that climb up, so that's good on XNet.
This is Bloomberg Markets The Open. I'm Emma Chandra here in the Hewlett-Packard Enterprise Green Room. Coming up in the next hour of Bloomberg Markets, Matthew Shea, the CEO of the National Retail Federation. This is Bloomberg.
Oil turning slightly lower now after climbing above $70 a barrel for the first time in 3 years as the global surplus in crude shows signs of easing back. Joining me on the phone, I'm pleased to say, is Randy Ollenberger, BMO Capital Markets Oil and Gas Producers Analyst, and Stuart Warder of BNP Paribas still with me here in New York. Randy, I want to begin with you, and I want to talk about a commodity before we talk about the equity.
Mine, the stochastic is kind of going down a little bit.
With Brent getting up to
So
$70
mine's
a barrel.
not in the best place right now, but XNAT is really trying. So that's good for XNAT.
Trying to get the oil price maybe towards the $60 level. I think 70 is too high, and we probably would see the cartel unwind that agreement when they meet in June.
Randy, there was an assumption that when we got through 60, when we got through 65, there would be a significant supply response here in the United
Buyers are
States.
trying
Have you
at
seen that supply
27 now.
response?
28.
Of course, but
So
right
they're
now,
trying to raise
companies
their
are still,
price a little bit, so
investing a lot
that's
of
good.
capital discipline, so they're really still continuing to budget around a price that's $5 to $10 below where the market is today. But keep in mind, we are still
I'm
gonna
still
see
at the
tremendous amount of
36,
production growth out of the
trying to
US
sell it
this year.
there,
We're
so.
gonna see probably just under 1 million barrels a day year-over-year growth. So we're still seeing a lot of growth. And you also have to keep in mind the strip is backwardated. So, the producers are looking at that calendar 19 and seeing that that's about 5.
Again, guys, just a friendly reminder, go to KandKstrategies.com, subscribe. If there's any issues with the subscribing, please make sure you send us an email, so that way we can get you going. That way you'll be able to join in on the live stream on Tuesday.
The reason we didn't see
So,
it is because
I hope
it
to
was
see
really
you all there.
perceived as probably temporary. I don't think investors were prepared to bet on a temporary rise in oil prices that really seemed to be tied to.
Yeah, today's the last day to watch it for free.
I mean, there's a
That's
big gap
correct.
there now on the valuations versus the broader market. We're trading probably at the widest discounts we've been in since the mid 2000s. So
Here we
I
go.
really do think if we've taken away the risk of a downside move in oil to something in the 40s, and we've got attractive valuations.
Kind of a little bit more heavier sell though at the 34. As soon as it can pass that and go to 36, it can try to get us out. Remember, we're doing limit orders, so it doesn't guarantee us getting out at the 36. We just hope to get out at the 36 with that sell order as a limit.
High margin growth stories. So, the Permian players that can generate improving returns on capital employed, we think those are the companies to go with. Think of Callon Petroleum or think of an EOG.
Stuart Warder, do you share that bullishness for some of the big names in equities for the energy space?
More buyers at the 31 now, so we may see it go to 36.
Outlook last month, which is that if you look at all the sectors and you look at the historic performance of crude relative
So this is
to
good that it's up
the
here.
energy sector itself, not necessarily the front month crude future because that's not necessarily a fair representation, but looking
Just
at the
need
entire
one more
strip,
penny up. Well,
we had
two
actually
more
seen
from
US
that,
shale
but
E&Ps that underperformed by roughly 30%. So, especially
buyers are trying to line up, so that's good.
Really interesting profile because the upside calls or the very out of the money calls are extremely well bid, and so that's interesting because it supports the idea that there is some bullishness for a rebound trade in the sector, but we still continue to underperform relative to either the moves in crude or the moves in the equity sector or equities more broadly.
Randy, before we let you go, I've seen some incredible numbers come from the likes of BP on where they break even now. Incredible changing over the last couple of years. What's your base case for the oil price that you base some of these forecasts on?
Yeah, we think the oil price for Brent is going to be, trading in this $55 to $65 range. We think $70 is simply too high. I think the industry is very comfortable in the $55 to $65 range. A lot of things work, including the oil sands in Canada. So, I think that's the upper end of the range.
Randy Ollenberger with BMO.
Okay, NYSE. It looks like we may make the X soon. So that's great.
Of record highs. The story right now at 142 on the Dow, up by a third of 1%.
189 is kind of like a resistance for NYSE.
And we look ahead to 2018 for some tax-related gains. The story in the bond market, core inflation in the United States of America accelerates, as does yields.
So NYSE, I would wait till it breaks 189.
To 257 on a 2-year. We blast through 2% for the first time since September 2008. It has been that long. In the FX market, the dollar still can't catch a bid. 91.28 on the dollar index. We're down by 0.6%. Euro dollar now up by almost 1 full percentage point. The economics are good, and the politics seem to be a bit more constructive as well, as Chancellor Merkel may well end up putting a government together as she inches closer to getting that deal with some of her coalition partners. Euro dollar
so close to bouncing on the 25.36 on the ARR.
From New York, this is Bloomberg.
So far not too worried. The only thing that's stopping me a little bit is so close on the stochastic to bounce down because it's already above the 80. Heavy sellers at the 35 though. We're still at the 36. Make the X on the stochastic, but start up here. So some of the 35 sellers are trying to undercut at the 34 right now, which I'm okay with because they will try to help climb it up a little bit more because it's at 33. We're not gonna undercut though. We want 35 or higher. We're trying to do at 36. Okay, so MYSE did break above that 189. It's at 190 right now, 191. So that's really good.
From New York, this is Bloomberg. Let's get through.
The sellers went back to 35.
Later today, we'll hear from Fed Presidents Harker and Rosengren, capping off a busy week of Fed speak. Monday, the U.S. markets closed for Martin Luther King Day.
And it just took a little dip right here.
Citigroup out before the bell. Wednesday, we'll hear from Bank of America and Goldman Sachs as well. Then through to Thursday, Morgan Stanley, the last of the big banks.
Heavy buyer at 29 though, even though it is kind of on a downtrend right there.
To finalize a spending bill to avoid a government shutdown. With me to wrap things up is Bloomberg's Lisa Abramowitz. Can we just talk about a move we're seeing in the bond market? What kind of significance, if at all, do you attach to that 2% line in the sand on a 2-year treasury?
I mean, it's great to talk about. I think that, look, it is a line in the sand, and I think that it's clear that people are
We're
ramping
still
up
okay,
their
though.
expectations for the Federal Reserve to hike rates. The Fed does not
Just took
have
a little bit
control
more down
over
hit,
longer
but that's
dated
okay.
treasuries. I'm frankly more interested to see the 10-year and the 30-year
25
yields,
is
how they respond to this
pretty good
increase
support,
in, 2-year
even
yields.
though it
What's
is,
interesting about this?
like I said, on its
Inflation
downtrend right
expectations
here.
are really what's going to drive
Hopefully the
long game.
stochastic
And
will really
inflation
help
expectations
there.
are picking up. So why aren't we seeing a steeper curve? Is the assumption still that the Fed's going to move too fast? Is that an accurate assumption?
I think that the biggest debate of 2018 is whether inflation expectations.
So MYSE did not make the X on the MACD, so looks like it may be curving down, so be careful on that. If you're short selling this, you know, I would wait till it breaks below the 176.
That intense, and you have to wonder if any extra hikes by the Fed will only slow things further.
So my question would be, the price action we've seen on the screen over the last month or so, do you view that more as hedging out exposure to the tail risk that is an upside surprise of inflation in 2018, as opposed to a change of a point of view, a change in conviction about what's actually happening?
I mean, to be honest, I don't know. I don't know, because when I talk to investors, they're buying. They're out there getting higher yields and very happy about it. And frankly, they see more value in even some longer midterm treasuries than they are in credit that offer a de minimis spread over benchmark
I'm hearing
yields.
the same thing. Robert Tipp over at PGIM was with me yesterday, and he said, you know what, the yields are backing up, you're selling, I want them, yes please. And we saw it in the 10-year auction as well, we saw it in the 30-year auction too, and you don't just see it in the sovereign space, you see it in credit in a big way at the start of this year.
I think that one of the big questions, I feel like we're on a precipice right now, specifically in riskier credit. The second biggest U.S. high-yield bond ETF saw the largest one-day outflow yesterday since 2012. We saw, just a little bit of a spread widening in the junk bond market, and yet over in Italy's like worst bank in the whole world, yes, just sold $900 million of the riskiest types of debt, and there was
the coupon like 5%.
It was unbelievable, and it was there was 40 billion. I mean, there was an incredible amount of demand for this debt. So, are we in a risk-on period right now? Are we seeing cracks in that? Are people starting to be a little bit more skeptical about this environment? These are the questions that I am interested in seeing for next week.
And I'm sure you'll be
lots more buyers at the 25. Okay, just broke down to 23.
Thank you very much. That does it for us. 26 minutes into the session. We're back where we have been throughout most of the last couple of years. Record highs on the S&P 500.
Down to the 20.
The bond market, the story as follows. Yields creep a little bit higher, but it's a weaker dollar that dominates G10 once again, as it did through most of last year. This was the countdown to the open on Bloomberg TV. This is Bloomberg.
Not too much is going on today. A lot of the stocks are kind of struggling pretty good, especially like the tech companies. They have been going down pretty good as well. So financials, they are doing their earnings next week, but like the big ones. So those are good to keep an eye on for next week. Pretty good movements. So trying to form the X right here on us, on the MACD. Stochastic saying though that it may try to climb up pretty well. Maybe. Looks like there's a little curve right here. Heavy sellers waiting at the 27. GE is down, AMD is down.
It is 10 a.m. in New York, 3 p.m. in London, and 11
Both of my monthly dividend stocks are down. This penny stock INNV that I have here is down. Lots of the stocks are down, but it's okay.
stories we're covering from the Bloomberg and around the world. U.S. stocks are hitting new records with equities at an all-time high. Where can you find value? Ben Laidler of HSBC explains why his picks are insurance and some in tech hardware. Bank earnings season kicks off with mixed results. JP Morgan reports a 26% drop in trading revenue, and Wells Fargo earnings take a hit due to ongoing litigation costs. And in technology, Facebook shares tumbling today after the company makes major changes to its news feed. Will that transition lead to people spending less time on the site? Well, it's about 30 minutes into the trading day in the U.S. As I mentioned, we've got records, and Bloomberg's Abigail Doolittle has been tracking all of the action. Not big gains necessary to get to those records,
That's true. That's true. Although the Dow pretty decent, up 0.6%. Another day of records once again. The rally absolutely just continues. At this point in the new year, we have 9 days, and 8 of those days we are looking at gains for the major actors. So lots of optimism.
Still sellers waiting at the 27.
Earnings have kicked off, as Julie was mentioning, for the big banks.
Okay, NYSE still struggling a little bit right there. It's getting close. So it did do its breakdown.
Reform and how it will be a positive for the entire country going forward. So that's
But the histogram right here is trying to bring it back towards the zero. So just be careful there. And the stochastic is trying to boost it back up. So it may not be like a very good breakdown. XNet, let's check that out. XNet is trying to climb back up right here again. Stochastic is trying to build it up. MACD is going up. So the 27, they went for the 26 instead. Some of them anyways. Some of them were bought out because of that. So that helps us. Tries to form the X to go back up because of it. It's great.
Kohl's up top, up 4.5%, upgraded at both RBC and JP Morgan. At JP Morgan to an overweight from a neutral, RBC to a sector perform from an underperform, and JP Morgan citing tax reform, brick and mortar stabilization, among other factors. And we see this is giving a nice tailwind to the entire department store space. Let's go a little bit macro.
Let's check out some other stocks in the meantime. Facebook, that's on the news. You can see here, it's been trying to climb back up. Gap down, but it's really trying to climb back up. Let's see here. You have Amazon. It's really trying to climb up pretty well. That's a nice rise that it's been doing.
Pretty remarkable. This is a long-term board of the 2-year yield, and the point I want to make here, look at it. It's back above 2%. For the first time, we have the 2-year yield on that CPI, that core CPI data mark. It is back above 2% for the first time since September of 2008, before the financial crisis truly kicked off with the fall of Lehman. Pretty remarkable, Mark.
Tesla. Tesla looks like it may become a buy right here, but the stochastic is kind of high. Day chart, it's trying to climb up, but the stochastic saying it may end up going back down here soon on the 100-day chart.
After about a decade, sending shares of Puma down by 7% today, acknowledging that its expertise rests with the
struggling
like Gucci, Saint Laurent, rather than developing the German track and field outfitter. Some investors may be hoping Kering would find a buyer, hoping to pay a premium. That's why shares are down by 7%. They did fall much more earlier.
Let's check out Apple.
On record a little bit earlier. That's Puma. This is the German
100-day chart. It's really trying to go, but stochastic is high. Points are touching. Everybody's favorite stock, Disney. Still at 111. So it's getting ready. Like the stochastic is trying to boost it back up. MACD may make the X because of the going back up. So that's one it's good to watch if you're swing trading.
To negotiate this coalition government. We're on track for a 4th weekly gain as well. Best run since August the 11th. The level to watch today.
Okay, mine's struggling still. So 22, 21.
and the 3-year high. We're way above that level as of now, Julie. We'll talk more in detail about the euro later.
Thanks, Mark. And let's get back to that Facebook story. Those shares are falling after the social network announced major changes to its news feed. Those changes could mean users spend less time on the site. Joining us from San Francisco is Jitendra Warl, who covers the internet and consumer electronics.
Sarcastic on mine, though. The second we make a turnaround, come back up. It may hit 20 though first.
Do you think that it will in fact lead to users spending less time?
Yeah, there'll be impact on that, but if you actually look at the total time spent on Facebook, core Facebook platform, it has been coming down because one of these issues where content from businesses is increasing, and also a lot of users are using Instagram more. So this is a good step for Facebook long term, but there's
a 20,
slight impact on
may break down to 19.
Now, Shira Ovide, who writes about technology for Bloomberg Gadfly, says the goal is to make Facebook feel less like a depressing cesspool, although she says, of course, Facebook didn't put it that way. Do you think that this will succeed in making it feel like a more positive experience to be on Facebook? And is that really what users want? Or do they want that little charge that they get from arguing over these news stories or from interacting with these news stories?
Yeah, I think, longer term, it'll be a positive experience, but near term, we have to keep in mind that Instagram is growing very, very rapidly. You know, this year, they expected to almost double their revenues over there, so there'll be offsets over here for the Facebook story. So Instagram growth, increasing ad pricing, and again, video advertising going up. These steps would offset some of these issues, but long term, it should be positive.
Jitendra, Mark Zuckerberg said last week his resolution for this year was to fix the social network he, of course, co-founded. What other measures might we see in 2018?
Well, we already saw increasing investments to address the fake news and content security issues. And I think, again, all these steps, like the fake news steps, what they're doing with audience engagement over here, these are all geared towards long term. But 2018, it might depress revenue growth a little bit. But again, let's not forget the rapid growth Instagram is facing. So they have some offsets over here.
All right, Jitendra, thank you so much. Jitendra Warl, who covers the internet and consumer electronics for Bloomberg Intelligence on that Facebook story as it falls. Now, from technology to banks, with earnings season now underway, JP Morgan, as we learned this morning, reported net income fell 37%. Wells Fargo's earnings took another big hit from litigation. But the big question for banks is how tax cuts will affect profits in the year ahead.
I'm not too worried.
JP Morgan CEO Jamie Dimon
trying to climb back up
in today's conference call.
It's the cumulative effect of retained capital.
A little sarcastic on there.
American companies
really try to boost it up. Keep in mind, this is like part of a reason why you always want to make sure you're trading with more volume stocks. This is just one of the monthly dividend stocks that I always watch, so I know it'll come back up.
Do you buy that argument?
It always does.
How much of a boost is this going to be for the banks, the tax cuts? Because in the short term, they took a hit, right, of $2.4 billion in the case of JP Morgan. How is it going to translate this year, next year, going forward?
So I think JP Morgan did the best job possible in terms of laying out what they expect that the effects are going to be. And broadly, I would say that the announcements were in line with expectations. The tax rate for 2018 at 9%, perhaps a bit better, perhaps in line with the bullish expectations for the bank. So in terms of the positive impact to the economy, basically what we expected, we're going to see hopefully a pickup in loan growth, could see a boost to equity fees, a little bit more negative on the debt capital market side. But I would say overall for JP Morgan, solid quarter, positive on the tax guidance, trading was a miss. But again, we saw sort of expectations even coming down as we went into the quarter. Keep in mind their guidance was in early December. But we saw expectations for sort of the banks that earn the most from fixed income trading coming down, I think, reflecting that. So we are starting off the year with a lower run rate. That is a negative, but not new news for the banks.
Right, and it seems like that news, the trading revenue news, is kind of still, that narrative has not changed, right? As we are into 2018 here, still early in the year, but
more buyers right now on the ARR, so that's great.
That you just don't count on in the near term to change.
I think if you look at volatility and if you believe in cycles, right, so we're hitting new lows across several asset classes last year, but if you believe in cycles, at some point you will see a pickup. Goldman has put out a slide and talked about in the past, sort of the correlation between volatility and sort of the magnifying effect that you get on revenues when you do get that pickup in volatility. And that's really been the issue for equities and fixed income trading. Keep in mind also the tougher comparisons. That's why we're seeing sort of a steep decline at JP Morgan. We're going to see even worse declines at companies like Morgan Stanley and Goldman next week, who had the strongest fourth quarters last year. But we really do need volatility to pick up to help client activity and just to help more things going on at the banks.
Alison, for Wells Fargo, the net interest margin missed. Bit of a surprise for investors in the form of the biggest legal charge yet. Is it not yet past its consumer banking scandals?
Lots of buyers at that 13. Look at all that.
This quarter was a big charge, and granted, this was
It's one person trying to sell it a big amount at the 15.
But a tax benefit from the new reforms. They also had a positive impact of a sale of a business. So when
Sarcastic
you get those types of
may help it try to
gains,
climb
you
back
tend
up.
to see one-time charges. And the Wells Fargo is the one bank that still has outstanding litigation related to the Department of Justice and legacy residential mortgage-backed securities issues.
There's a
The
15.
charge they took of about $3.3
Where's
billion
lot
was bigger
spot?
than we had expected.
That's good.
They have already taken a $1 billion charge last quarter. We're going to want to hear, so how much of that 3.3 is related to DOJ and how much is related to ongoing issues. But to the extent that they are just saying, look, let's be as conservative as we can in terms of trying
Here's
to
a
get the
climb back up. Looks like we may make the X here.
the other thing that
That's
was
what we
a
want.
bit negative in the quarter was ongoing operating expenses. The guidance for those expenses a little bit higher, I think, than people had expected. But I would say that we do have their investor day coming up in May. That gives them, I guess, sort of another bite at the apple, if you will, in terms of, how are things running at that point. And I think it's really going to be the guidance and what we hear from the company in May in terms of their ongoing profitability. Hopefully most of these issues behind them at that point.
Right.
Hopefully from a monetary perspective, getting behind them in the fourth quarter and moving on.
Right, and Wells shares down, JP Morgan up in the wake of these numbers. Allison, thank you so much.
Let's
Allison Williams,
watch
Bloomberg Intelligence Senior
BO.
Analyst for U.S.
Let's
Bank.
see.
Appreciate it. Let's check in on the Bloomberg First Word News now. Emma Chandra has more.
Thank you, Julie. President Trump denies that he said anything derogatory about Haiti. The president said to have used foul language while asking lawmakers why the U.S. accepted immigrants from Haiti, El Salvador, and Africa, but not from places like Norway. President Trump says he has a wonderful relationship with Haitians, but Democratic Senator Richard Durbin, who was in the Oval Office with the president, says the president used those vile and racist words. Meanwhile, President Trump has decided to extend sanctions relief to Iran once again. According to a person familiar with the matter, the White House will announce today that the president will leave the 2015 nuclear accord intact. That will give the administration and Congress time to develop legislation imposing new restrictions on Iran. It was a holiday gift for U.S. retailers. Retail sales increased in December for a fourth month in a row. Sales were up 0.4% after jumping a revised 0.9% in November. That was the strongest gain for November and December since 2010. Global News, 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Emma Chandra.
Sellers are trying to line up right now.
Emma, thank you very much. Right, coming up here on Bloomberg Markets, stocks are up today. There may still be pockets of value up there, from insurance to technology. We look at the sectors poised for further gains. This is Bloomberg.
Okay, they dropped it to the 18. Okay. Looks like it may bounce off on the stochastic. Again, today, not too much is happening at all. So, it's more of just a waiting game of when we can get out right now with ARR.
From London, I'm Mark Barson.
And from New York, I'm Julie Hyman. This is Bloomberg Markets. Stocks rising in the U.S. to records and also rising in Europe today as the rally of 2018 keeps on rolling. Joining us is Ben Laidler. He's global equity strategist at HSBC Securities. He has a year-end target of 2850 for the S&P 500, so looks like still potentially more upside from here, although not as big a gain as 2017, which seems to be the consensus here. But with this kind of momentum, do you rethink that, or do you think it's going to moderate at some point?
Okay, more buyers at the 14.
We have 6-7% upside for global equities this year. We don't think you're going to see
Not too many sellers right now, so it could help move it up a little bit.
We have very good visibility on pretty strong earnings growth, double digit. I think that's going to be delivered. I think the question is, what do you pay for that? I think with global central banks increasingly beginning to taper, tighten, raise interest rates, whether it be the ECB, the Bank of England or the Fed, what you're going to pay for those multiples, what they're going to pay for those earnings is going to come down. Right now, clearly, I think we're seeing a big sort of beginning of the year reallocation, especially from local investors or retail investors. There's clearly a lot of growth momentum. PMIs at 80-month highs, oil prices $70. I think that's sort of fueling this beginning of the year rally.
And as we look to the bond market, we see those yields on the 2-year hitting 2%. Are rising yields going to be a headwind for stocks at all this year? Or are we going to see rotation out of bonds and some of that money coming into stocks?
I do think they become a headwind. I think that's one of the ingredients of this sort of cap on valuation.
Probably hit the 18 here soon. May bounce off of the stochastic here and go up.
You've seen nearly a 10 percentage point decline in equity valuations every year. We saw the opposite of that last year. Multiples
BOSC, good penny stock. Struggling right now, deciding am I going to go up or am I going to go down. Stochastic may help it move up though.
I know you're seeing a divergence among defensives, aren't you?
Absolutely. Things like consumer staples are looking actually really good right now, quite out of favor, but with earnings momentum recovering. Things like utilities, very sensitive to these rising bond yields, and it's quite negative for utilities, looking quite poor. On the more positive side, the only two industries globally that are in our sort of out of favor but seeing positive earnings revisions and momentum is tech hardware, which surprisingly, even after the huge rally last year, is still quite out of favor, and insurance. If you want to be overweight financials, and clearly lots of people do right now with bond yields going up, we think insurance is the place to be.
Yeah, you often talk about thematic investing, Ben. You've got this new thematic sentiment barometer. What's the highlight? What's it flashing right now?
So the two things it tells you that are out of favor right now, one is this sort of lower for longer investment theme, and we think inflation's staying low, bond yields are staying low. Clearly, the market doesn't believe that right now. We think so. You think you're going to get some people are going to come back to that theme later in the year. The other one, interestingly, tying back into the sort of Facebook story, is environmental, social, and governance investing. That's quite an out-of-favor theme, and we think some of the news.
More sellers right now that just lined up all of a sudden at the 17.
Things more seriously could see people revisit some of that. Just more broadly, I would just say I do think the investment world is changing. I think we're going to be investing a lot more on a thematic basis going forward than on a more traditional sector and country basis.
Again, today's not much is happening. We're just trying to sell when we can. Kind of watching the rest.
The way to play them right now.
So we have a bunch of screens on ways to play this. In short, the consumer theme and the tech theme is really an EM and Asia theme. 90% of middle class growth globally, and basically all the sort of young tech adopting consumer growth, that's all coming out of Asia. So really it's a very EMIT theme if you just want one sector to play.
All right, we have to leave it there. Ben, thank you so much. Ben Laidlaw, good to see you, Global Equity Strategist at HSB Securities. And still ahead, dialing up some returns. We'll look at whether telecom ETFs are about to take off.
Buyers are trying to raise their price. Sellers just raised their price as well. So that's good. What's the 5-minute look like? 5-minute looks like it's been on like the downtrend, right? Histogram may try to climb up a little bit back towards the 0. So that may be what we're waiting for there. Histogram on, the stochastic on the 5-minute. It's good for us. So I like what I see there. Sellers backed out a lot on the 18. Sellers are waiting at the 19 and 20 right now. We're at the 19. Still it is trying to climb up, so that's what we need. Heavy sellers at that 19, just waiting.
This is Bloomberg Markets. I'm Mark Barson from London.
And from New York.
Some are trying to undercut to the 18.
ETF Friday, S&P Dow Jones Indices and MSCI announced last night that they are rejiggering sectors. They do this periodically, and also which companies go into those sectors. Thanks to this reclassification, telecom ETFs, which had been in no man's land for a decade, are about to get a huge influx of hot stocks. Eric Balchunas of Bloomberg Intelligence is here to explain. So what does this reclassification look like and what goes where?
Sure. Now, it was announced 12 months ago, but what was interesting last night, they gave the specifics on the stocks. So now we know what's happening. So I have some numbers for you. 52 companies are moving to telecom, which will be renamed the communications services sector. Here's some big ones moving: Google, Facebook, Disney, Comcast, Netflix. I added it up. The total market cap of the stocks moving is 2.5 trillion. The total market cap of the telecom sector now is 500 billion. So this is 5 times just coming in on top of the telecom sector. And here you look at the ETFs. The telecom ETF assets are almost invisible compared to other sectors. So 2 billion, that's 1/40th of what tech has. So this is extraordinary. This is like all the cool kids moving to a farm town and making it like hip again.
So is there an automatic rejiggering in the ETFs, or do they have to introduce new ones? How does that all work?
So I don't know. It's an open question. Here's what I think might happen. Remember when real estate became a sector?
Right.
I'm guessing Spider will launch a new sector ETF and then maybe do a special dividend in the form of the new ETF share, something like that. But there's going to be big capital gains. I don't see how they can avoid it, even as tax efficient as ETFs are. If you look at the actual telecom sector, there's only about 5 ETFs. So Vanguard has one. Vox is the biggest. So you got a big company, big stocks in there. I think are Comcast. You've got AT&T, and then you've got iShares has one. Fidelity. I mean, that is small. I mean, five ETFs. I would bet that's going to quadruple in the next 9 months.
And of course, they'll be renamed communications.
Yeah, you'll see Smart Beta. You'll see the small cap. You'll see the whole sort of like product line get launched.
And one would imagine that this would mean money into some of these individual telecom stocks as well, as they're included in these rejiggered ETFs.
Yeah,
right?
this seems a little like the
Every
China
seller's
A-share
still
thing
at
in a
the
way, except for these old telecom companies are now about to have
17.
all this money get dumped into them. The way A-shares are a place people are going now as they're going to get moved into bigger benchmarks.
All right, I got to ask about something else really quickly here.
Buyers are trying to line up at the 15 again, so that's good.
Next week, before any Bitcoin ETFs, we should mention.
Yeah, well, these are just holding equities. That's why they probably got approved quickly. Reality Shares has one and Amplified both anticipated, not certain, but on Wednesday they'll launch. They're going to hold companies like Accenture, probably IBM, and then also some of the pure play stocks. Anything with blockchain in the name, as you know, goes to the moon. So I guess it's interesting, two launching on the same day. We'll see which one, but this is a $100 million ETF probably within a couple weeks, depending on which one people choose.
As we know, anything that mentions blockchain or Bitcoin or crypto, anything these days, has been going straight up. Thank you so much, Eric Balchunas of Bloomberg Intelligence. Mark.
Julie, great chat. Right, coming up still ahead, retail sales continue to have momentum in the US. We speak with Matthew Shea, Chief Executive of the National Retail Federation. Plus, we look at some of the drama surrounding Germany's Puma, which is sinking today. This is Bloomberg.
Back down to 14. Looks like I might make the X to go down on the MACD on my ARR, but stochastic is really low, so I may bounce it back up. Still, again, nothing much is happening. It's on the 14 is a heavy buyer point right now. Minute, let's look at the 5 minute. 5 minute histogram, still trying to head towards its up, so still fine on holding on to that. Heavy buyers still at the 14.
World headquarters in New York. I'm Julie Hyman.
And live from Bloomberg's European
There's the
headquarters
15.
here in London, I'm Mark Barson. This is
Sellers waiting at the 18 right now.
Let's check it on Bloomberg First Word News. Emma Chandra has more from New York. Emma.
Thank you, Mark. President Trump insists he didn't use foul language to describe Haiti, El Salvador and Africa during an Oval Office meeting on immigration. But a Democratic senator who was there disagrees. Richard Durbin says the president said things that were hate-filled, vile and racist. Meanwhile, President Trump has now received a study on steel imports that could lead to tariffs. The Commerce Department put together the report on whether foreign steel shipments are harming national security. The president now has 90 days to decide whether to impose tariffs.
Back at the 17 here. That's great. Still, sellers are waiting at the 18, so sellers are now waiting at the 19.
The big reason was higher costs for housing. The broader CPI gained just 0.1% thanks to lower energy prices. It's the rich list that wealthy Russians don't want to be on. The U.S. Treasury Department is finishing its first official list of oligarchs close to President Vladimir Putin's government. That set off a flurry of actions by rich Russians who want to shield their fortunes and their reputations. The report is expected to amount to a blacklist of Russia's elite. Global news, 24 hours a day, powered by more than 2,700 journalists.
Okay, buyers are trying to buy at 18 now, so this is what we've been waiting for. Just a heads up, and guys, I will only be streaming for about another 20 minutes, and then I will be heading out, so hopefully it goes all the way back up to 36 and we can get out by then, but if not, then I will be headed out. But we got another 20 minutes for that.
$92 billion. What was driving this? Because indeed it was sort of a rocky year for retail, particularly certain areas of retail.
Yeah, certainly I had one CEO describe it to me at the end of last week as a hockey stick year, where the
buyers are heavy at the 18, sellers are kind of slowing down a little bit, so this is good. Although the stochastic is pretty high.
Stronger than expected employment gains in October, November. That led to increased wages and more consumer spending. And I think as we got closer to the holiday season, we saw Thanksgiving weekend very strong numbers, and at that point we all knew that we were in for a pretty good year. And as we got closer to the end of the year, we saw the tax reform deal all come together, and I think sort of the animal spirits got unleashed. People felt very good, they felt confident. Companies were announcing bonuses that were going to take place and wage increases. There's just a lot of positive momentum that carried through the end of the year as a result of that.
You know, it's really interesting when I look at the breakdown of sectors here. The biggest increase was in building materials and supplies, which isn't something you normally think of as coming in your holiday stocking, right? You get a 2x4. But was this sort of a lingering effect of hurricanes and whatnot and people rebuilding, or is there something there?
Still heavy buyers at the 19.
Retail spending.
I think it's probably a combination. If you go through all of the categories, I think virtually every one of the categories was up. Electronics was up, apparel was up, home goods is up, furniture is up, so they're all up. That one happens to be up.
The next 5-minute candlestick starting in about 40 seconds, so this is going to be really good for us.
So great growth, nice distribution across the segments.
Let's actually put it here.
The hurricanes, that was an input that went into a lot of the forecasts that people put out, ours and others included.
So we can watch a 5-minute on that.
Looking at the two hurricanes at the end of the year.
So you can see it's really trying to form its X to go back up. So I'm very happy to see that. Buyers are lined up at 20, 21 now. Not too many buyers, but it's still buyers there.
39% of all online holiday sales. So when you talk to your members, how
So
are
this is
they,
really good for us on the 5 minutes.
participating in that and trying to get some
So I'm not too worried. I think even if I leave, it will hit 36 and it will get me out.
A to Z if you include Zappos, so we've got a nice distribution across all the channels.
But I'll be watching it, of course, on my phone.
The that's out there is that it's sort of online versus retail. We know that 7 out of the top 10 and 21 out of the top 25 largest e-commerce platforms are operated by retailers who have been in the bricks and mortar business for a long time. So e-commerce is a channel. Mark Laurie, the CEO of Walmart's e-commerce business, who's the former founder of Jet.com and Diapers.com, Soap.com. Right. Mark said at our conference last September, you know, e-commerce is only supposed to make us better merchants. It's not an end in and of itself. It's a means to an end. And the end is how do you become better merchants? So I think we've seen a lot of companies in the holiday season.
Yeah, it's a little bit red right here, but it's okay.
Under a lot of pressure, they did very, very well. You look at Costco, you look at Target, you look at Walmart, you look at Best Buy, you look at Ulta. There are companies in every category virtually that have found ways to compete very successfully in this hyper-competitive environment. And their online sales are going 45, 50, 55, 60% a quarter. Now, obviously, it's off a smaller base, but they're making great strides there and connecting with consumers.
So I guess perhaps the wrong way to think of it is online versus bricks and mortar.
Buyers are slowing down a little bit. Again, according to the 5 minutes, okay.
As you say, Amazon's a member of the organization. organization, and so are all these other retailers. But it must feel a little to them like when Walmart was expanding aggressively in the 80s and 90s and taking a lot of business from other types of retailers. Is that a challenge that your members are
you know, the thing about retail is that there's always been disruption in the industry. 125 years ago, there was this company called Sears, and Sears was disrupting all those general stores out on the prairie. Because Sears had this catalog, and you ordered it, and it came, and it got delivered at the train station. 60 years ago, 50 years ago, it was Walmart. There's always been disruption in the industry. What's happening now, the disruption is taking place with a level of velocity.
Bank of America is close to $31 a share, so that's good.
The entertainment industry and healthcare and happening everywhere. And it's also very transparent because all of us have relationships with as consumers with retailers that we don't have with those other businesses. So we think we know what's happening because we.
So it did take a little dive right here. Again, we're still okay.
That's part of what this is all about. It's helping people understand it's not us versus them. It's all part of retail. So whether it's online, bricks and mortar, if it's on your phone, if it's on
Sellers
your
are
mobile device,
lined up a little bit at the 18. Not too many buyers at the 16.
Given Walmart's announcement that it is raising the minimum wage that it pays for workers, that will probably have a ripple effect. Is that something we're going to see from other?
Again, guys, make sure you're subscribing at KNKStrategies.com. If you have trouble subscribing and it won't let you pay or for whatever reason, email us at stocks@KNKStrategies.com.
If you go back 3 or 4 years, the retail industry has been leading in this area already. Walmart made a big announcement a few years ago about increasing wages and predictive scheduling in their training academies. Target has done this, TJX has done this, The Gap, McDonald's, Starbucks, Costco. So I think it's reflective of the fact that the retailers are the largest private sector employer in the economy. 42 million Americans, 1 in 4 jobs are tied to the retail industry. So retailers experience the issues that happen out in the labor market more quickly and maybe more acutely than others do. When it gets competitive, that's part of it. Part of it is retailers recognize, back to your question a minute ago, if they're going to compete successfully in this environment where there is so much competition and such a premium placed on the way in which you engage with your customers, that they need people that are skilled and well-trained and educated and can really deliver the results that they need. So I think it's a combination of all those things. Walmart made an announcement the other day. I think you're right that others are going to look at the increasingly tight labor market. They're going to have to do similar things to compete. Walmart's the biggest of the employers. They see it first. They see it a year before anyone else does.
Just very quickly here to wrap it up, you mentioned that retailers were describing this year as a hockey stick. What does 2018 look like? Does this holiday season provide a reset, or was it just a blip and we go back to that rocky environment?
I think we've got a lot of.
So we get about 40 seconds till the next 5-minute candlestick starts.
We had the tax cuts take place and will implement themselves this year, so we know consumers are going to have more money in their pockets.
That's
companies
good.
are going to have a reduction in the corporate rate. The analysis that we've done in conjunction with the Joint Tax Committee shows that
And
this
then
could
drop
result in $100 billion
as much from this downtrend that it did. This 5-minute candlestick that it was just passing. So buyers are lining up at the 17, sellers are lining up at the 19. More sellers though.
Thank you so much.
Nice to see you.
That's
CEO of the
okay.
National Retail Federation. Appreciate it.
Thanks, Julie.
Mark.
Julie, great
5
chat.
seconds.
Now let's turn to retail here in Europe. Shares of German sports apparel company Puma today tumbling on news Kering was giving up control of the business. The Gucci parent will distribute 70% of Puma shares to its investors. Let's bring in Deborah Aitken, luxury goods analyst for Bloomberg Intelligence. There's so many great headlines, aren't there? These shoes don't fit. Gucci parent Kering returning its ill-fitting Pumas. You can have a lot of fun here, couldn't you, Deborah?
Sellers,
Did it just not
19.
fit anymore in the luxury wardrobe?
I think it was never about luxury. I think it was about the sports lifestyle area, because Kering has so many brands that really are truly luxury. But I think it was more about the fact that actually if we look at Kering and what they've been saying, they've done ever so well with their biggest brands, and they didn't feel there was much more that they could do with Puma. So it's not a surprise to us, and I'm just surprised that the share prices react.
Yeah, why do you think it's responding?
Okay, buyers slow down and they're getting ready at the 16.
Off the lows, but still 6% lower. Did investors expect
Again, this is part of a reason why you want to be very careful with low volume stocks.
A sellout, but I do think when we look at the portfolio of what Artemis has, who will be the majority shareholder with 29%, that they're well equipped to do well with the brand, and it will be the management of Puma who continue to manage the brand and are doing very well in the turnaround.
How's Puma changed over the years? I mean, 2007 is when Kering picked it up. We've seen expansion into sort of Rihanna type. You'll tell me all about that.
We have. I think, but it also it's about shifting the marketplace. So I think we need to
Still on the histogram on the 5 minute, it is headed towards the zero a little bit better. So yeah, it may be down a little bit, but that's okay.
Team's margin at the time was growing very nicely through the sports lifestyle phase, and we've gone through probably 30 years of about every 7 years switching between the real heavy-end sports industry into some kind of fashion element. And I think it was just maybe caught at the wrong time then. But when we look at what they did in the half year and the end of last year, they're turning around margin. It's the best in the last 4 years, but it's still only mid-single digit, and that's only about a quarter of what
And how does it fare versus Adidas on sort of the key metrics?
It's back there in terms of the sales growth, but it was against an easy base, and it's still probably 200-300 basis points behind Adidas, and then further behind Nike, for example, with the kind of range of
and for
teams.
Kering, what next? What does this tell us?
So I think the big thing when we look at the structure, it was 70% luxury goods, 30% sport, mostly Puma. And what it does, around 20% of Kering's brands, Brioni, Balenciaga and others, aren't really performing as well as they could, so it has a huge amount that it can do with that 20%.
So it's stuck between the 17 and 19. But heavy sellers still at the 19. Buyers slow down.
It raises its margin immediately by about 400 basis points, so it puts it within the mid to top range of its peer group on margin.
Deborah, great to see you. Deborah Aitken there, luxury goods analyst for
Go. 5 minutes trying to really help it.
Julie.
Mark, coming up,
Little
Facebook
gap
is
right
our stock
here.
of the hour. We've been talking a lot about it. It is falling on those changes to its news feed. This is Bloomberg.
Sellers are at the 20. One minute, 10 seconds, so the next 5 minute candlestick starts. Hopefully that gives you guys an idea that I really watched for the 5 minute. 5 minute helps the stocks really move. So. Buyers are trying to boost it up now, so that's great. Five minutes started here, so close to forming the X. Histogram, it is at the 0. Stochastic, it's kind of struggling a little bit, but not too much volume. That's happening at this minute. So.
This morning after the company says it's making major changes to its flagship social network. It's shifting users' news feeds back toward posts from friends and family and away from businesses and media outlets. And it's a transition that is likely to mean people spending less time on the site. Taylor Riggs is with us now to discuss this. Taylor, it's so interesting because it's something that users have been asking for, essentially.
Heavy seller still at the 20.
Facebook some short-term pain.
Yes, and there's an analyst who highlighted that very well, and he said this is a change that was built in, that people wanted and good on Facebook, even though it might not necessarily be
Looks like
good
it
in
bends
the
down
short
a little
term for
bit.
business. One key thing that you mentioned is it means that there might be less time
14
spent
is
on
that
the
support
site.
though.
We have a chart here, G#BTV2339 of daily active users. Yes, it exceeded 2 billion in June for the monthly active users, but that user has been slowing. You're now seeing growth of both daily and monthly active users slowing to about 15% versus 16.5% that was in the fourth quarter of 2016.
And I just want to mention as well a chart that our Dan Curtis, one of our chart gurus here, brought to my attention. G#BTV5751. This is daily active users as a percentage of monthly active users. So this has also been slowing down. Just the daily use is not as much, and presumably this would hurt that further.
Exactly. And, you know, the CEO, Mark Zuckerberg, came out and said that community feedback has shown this, that the public content is crowding out these personal interactions, which takes away from their primary goal. And the whole point is to have better interactions and highlight posts that create more where you can comment and interact with other people. We also have another chart showing revenue, because a lot of questions then came up about what does this mean for revenue growth if you're changing the way you're going to see things on your newsfeed. You have revenue growth that looks like it may be slowing. When we were talking about if this had already been priced in a little bit, revenue growth now expected to slow to 26% year over year in 2019. That's down from when it was growing as much as 60% just 4 years ago. But the company's saying this will not impact ads, just impact sort of the way you see the posts on the newsfeed.
Taylor, is Instagram going to be Facebook's saving grace given its younger user base?
You know, Mark, I think that will be a key here. So the good news is Facebook already owns Instagram, and they are
So I'll be live streaming again for another 2 more minutes, and then I'm going to be headed out. So we'll see what the next 5-minute candlestick helps over here. If it tries to form the X.
And it's making up almost now 20%
It's very promising, actually.
Revenue that's coming in from mobile. So that could be a good thing here.
And there you already don't see much of these news stories that you're talking about. You see fewer than on Facebook. Photos, yeah. Exactly. Taylor, thanks so much. And let's stick with technology. General Motors wants to launch a self-driving car without a steering wheel or pedals. Dan Ammann, president at GM, joined Bloomberg, and he explains why he's handing robots the keys to the self-driving Chevy Bolts.
It's a pretty exciting next step on our road to deploy these vehicles in 2019.
30 seconds.
Everything we're doing on the path to that point in time is all about safety, and safety being the overriding priority in all of our development around AV.
There's a small chance I'll take the loss later on today, but as of right now, I'm not too worried. It has the rest of the day to climb up.
The National Highway Traffic Safety Administration. What will that process be like? Are you confident that you'll get approval?
Yeah, as I've said, the overall approach and one of the biggest benefits of this technology is all about safety, and that's obviously the objective that NHTSA is focused on as well. So we look forward to working with them to explain our approach to the technology and why we believe we'll be ready to deploy in 2019.
Give us a sense, Dan, because you understand this so well, of how much more complex it is to be in an urban environment with a fully autonomous vehicle than some of the things we've seen already.
Sure. So we're deploying, or we're testing our vehicles rather in both San Francisco on the one hand and also in Phoenix and Arizona on the other. And so those are two quite different testing environments. And our vehicles that are driving in San Francisco see more in 1 minute than the vehicles in Phoenix see in 1 hour. So that gives you a sense
Tires
for
are at the
the
15.
level of complexity that we see in a complex urban environment. And that's why we're so focused on testing in that kind of environment, because we
Hasn't formed the X yet on the 5-minute.
and it puts us in a much better position to be ready to
And that's what the stock is waiting for.
in the 2019 timeframe.
As we're speaking, we're showing the viewers the Bolt with the cruise on the side of it that you'll be doing. This will be a Bolt, as I understand. It's what you're doing.
HTO Mario, you're short. You can't even see me, Jeffrey.
Of EV, AV, as well as ride sharing. I mean, where are we in the early innings, the middle innings? How soon will this come?
Look, I'd say it's obviously very early days still, and we're at the very beginning of what we see as a long-term, very fundamental transformation. We do believe this technology, autonomous technology in particular, will change the world.
Alright, so I am headed out. I will be back on Tuesday. So wish you all the best of luck and see you then. Keep in mind again, visit us at KNKstrategies.com. Subscribe there because you'll be needing to be a subscriber to watch starting on Tuesday. So if you have any trouble with subscribing, email us at stocks@knkstrategies.com. You all have a great day.